Amazon and Google just closed out their worst months on Wall Street since 2008. Check this one out. NASDAQ 100 falls 13% in April, which is the largest monthly drop since 2008. If those aren't some scary headlines, and I don't know what is, because that is absolutely crazy. The NASDAQ 100 falls 13% in a month. Now, April historically is the strongest month for the stock market. Historically speaking, the first half of the month is really bad because you got the deadline for taxes. A lot of people have to sell stock to pay taxes. That's the running theory. The second half of the month is usually very bullish, returning on average close to 2% for the month. Well, we lost 13% in the month. This is like a really bad year loss for the S&P, for the NASDAQ. 13% is what you would expect in a year when a recession is actually happening, right? So it was very bad. So I just want to say, if you're still here, if you did not leave the stock market, then congratulations. You, my friend, can get through pretty much about anything. Hopefully it doesn't take too long to come back to life, and hopefully we get to buy the dip as much as our hearts desire before that moment does happen. Now, here in this video, I want to talk about what I mean when I say margin calls are happening. A lot of people get very upset in the comment sections whenever I talk about margin calls, and you shouldn't. Some people say, you know, I don't provide any factual data. I don't show a chart, because there's no chart to show. I've been doing this for the last 5 years. I've lived through the 2018, 2019, 2020, and now 2022 stock market crash. And there is a difference between just a down day in the markets, or a bad month, or a bad week, compared to what we are currently seeing right now. And I want to talk to you guys. What is happening? Why is this going on? Because face value here, yes, there's a war, superpower, if that's what you want to call Russia. They have nuclear weapons. They're at war. They're threatening the world, especially the United States and Europe, with nuclear weapons. They're cutting off gas, natural gas. Oil is through the roof. There's a lot of things happening on the surface, but does it really amount to a massive sell-off? I want to go over my opinion on what is truly happening here in the markets. On top of that, I do want to go over everything you guys need to know for AMC stock and what happened in the last week, kind of what to look forward to heading throughout the, next couple of weeks. So hit the like button, subscribe to the channel, do what you guys got to do. Now let's get straight into this video. Like I said, it was very bad. Today, or I should say yesterday, was terrible. S&P dropped 3.63%, NASDAQ dropped 4%, a new 52-week low today. So we are closing at the lowest levels that we have seen in over 1 year. Let that sink in a little bit. Not even just the start of this year, but you got to go back a whole year to, be these levels on the NASDAQ. And also for the S&P, it's getting very close to those levels. You're technically down on a year-over-year basis at this point. So I feel people when they say, they're scared and they just want the pain to stop. I get it. If you lived through the crash of 2020 and you were fully invested in the markets, then you kind of get it. These things happen and they tend to reverse very fast. Now, this time might be a little bit different. You might not get a quick reversal. And why do I say that? Well, what is actually going on and what is fueling these margin calls, right? Because you guys got to keep in mind, margin calls mean if you have margin in your brokerage account, these hedge funds, these institutions, or regular people like me and you that don't run Wall Street, right? We're not citadels of the world. We can still get margin called. They can still get margin called. Anybody can that uses margin. Essentially what happens when you see the NASDAQ down 13% in a month, down over 21% to start the year, if you had margin and you were a hedge fund in any kind of way, and you were specifically in a lot of stocks that are down massively, you can only hedge for so long. So like buying puts, right? They call it premium because it's like your car premiums. It's insurance. But how long do you need to be insured for? That's the thing. Puts, it's expensive. That insurance is not cheap. Just like car insurance, like anything else, it's very expensive because it's very risky. There's a direct correlation between cost and risk. Stocks are risky, so the premium is very expensive. Now, you can protect yourself for a short amount of time, and it isn't too bad. But when you have to protect yourself for now, I mean, to start the year, we're what? Almost five months in now. And if you didn't protect yourself, you're still getting absolutely destroyed. Now, that's one part of it, right? Insurance is very expensive. Not all hedge funds are going to perfectly hedge for the downside. That's the nature of it, right? If you don't have to spend a bunch of money on insurance, why would you do that? Think about this in the context of how you can relate to it, your personal life. Now, when you're thinking about why this is different, well, it's different in the sense of this is the worst sell-off since 2008. The last time, obviously, in 2008, there was real problems going on. The banks were corrupt. People were giving loans to anybody. People were defaulting. They were collateralizing these bad assets and betting against them. Like, it was the worst case scenario that happened 08 and 09. Really, from like 08 to 2012, that's when the stock market finally hit a new all-time high, was 2012. Now, are we in that same situation? Is there systemic problems going on? Well, I think it's a little bit different. Back in 2008, the banks were really doing a lot of the risky behaviors, right? Some hedge funds were, but I think what is happening right now is the expectations of growth substantially slowing down. Like going into a recession, we just had the first negative print to our GDP that we have seen in years, right? It went down 1.4%. Now, if we get another print to GDP that is negative, you're technically in a recession. So you have that going on. You have the Fed and super high inflation. Nobody knows how aggressive the Fed is truly going to be. The reason the stock market has not fallen more until we just spaz out and drop 4% on the NASDAQ, the reason we've held up, especially in some key stocks like Apple that control the broad markets, is because the markets don't really believe the Fed. The Fed during 2018, 2019, they talked a big game. What ultimately happened? The stock market couldn't handle it. The economy could not handle it, and they reversed courses. This time is different in the sense of you have to get rates up. There's no way around that. Like, if the economy substantially started to slow down, the Fed is going to have to go more aggressive. They're going to have to get more aggressive because the only thing the Fed can do once crises happen, right, like COVID, like 2008, they come in, they lower rates. They can increase their balance sheet. Well, if your balance sheet is $9 trillion, 10 times the level it was during 2008, and you literally cannot sustain that balance sheet, like quite literally the Federal Reserve on paper is insolvent. Like, they would not be around if they were a normal bank. So there's that. And then if you cut rates, you can only cut rates to zero. If rates are currently sitting at 0.25%, you got a lot of room to go before it would even be meaningful to cut rates. Like, the Fed is going to at least have to get rates up to 3.5% by the time the recession comes, so they can ultimately cut rates. That's, what happened during 08. Well, from like 05 to 08, they were raising rates steadily, pretty much the whole time. This is the federal funds rate, right? They were raising rates all 2004, all this time. Everybody was having fun. Money was everywhere. People were just gambling and doing risky shit. You could say that's what is also going on right now. But they raised rates for a while. They had rates at 5.25%. Then what happened during 08? Well, they dramatically started to cut rates all the way down to 2%. And then they ultimately went to zero when things were really, really bad. Like halfway through the recession, they ultimately went to zero. Well, look where we are at right now. We're right here. So if we start to get a slowdown, unemployment starts to go up, demand really starts to go down, the Fed is going to have no choice but to potentially give us 1% interest rate increases. If things really come down to the wire, that's what is going to have to happen. You can forget a soft landing. So the markets are kind of starting to expect that a little bit more, but believe it or not, the markets tend to actually crash and come down in a substantial way once the Fed actually cuts rates, right? What you can see, Fed cut rates right here, recession. They cut rates right here, recession. They cut rates right here, recession. And you can go back throughout all of history. That's what happens. Right before recession, the Fed will cut rates. You know, and it's not a good situation when you're talking about the federal funds rate being at 0.25% and GDP starting to reflect down in a very substantial way. So I really think that is currently what is going on behind the scenes. The markets are starting to expect the Fed is going to have to get super aggressive. We're not going to get a soft landing, and we're heading into a recession possibly later in this year. The GDP print was not good. Now, the markets were expecting that, hey, maybe earnings will save us. Well, when Amazon drops 14% a day, down as much as 18% at one point, when Apple had good earnings, but they said, yeah, you know, we're starting to see some problems with our supply chains. We'll chalk it up to that. We're going to lose like $8 billion next quarter. That's what they said. People don't know if that's just demand slowing down and them trying to push it off on supply chains. That's kind of what the markets are thinking as of right now, which is a very logical way of thinking. I've been predicting a demand slowdown for Apple for quite a while. So either way you chalk it up, earnings did not save us across the board. Like Microsoft was the only company, Microsoft and Tesla were like the only two companies that had just perfect earnings, like beyond perfect. You wouldn't have expected earnings that good. All the other stocks that really have reported so far have said troubling things, or their numbers have just been very bad, or just given weak guidance overall. So that's what is currently happening right now. And depending what happens next week with the Fed meeting. We do have a Fed meeting on Wednesday, 4 days, 21 hours, and 54 minutes away. That comes at 2 p.m. on Wednesday. Now, this could be a buy the dip kind of opportunity. Like we seen last time, that's what kicked off this whole rally was the Fed, right? In here, March 14th, March 15th, the rally started because the Fed raised 0.25%, and the fear was essentially gone. The catalyst was gone. This time is a little bit different because we're at these lows. Who knows what's going to happen heading into the Fed meeting? I imagine next week is going to be pretty bad because there's a term called sell in May and go away, and I'm gonna make a whole video on that because I think that's a much broader topic that you guys need to know about in general, and I want to give it, you know, justice to make a video about it because I think it's very important to keep in mind throughout the next couple of months here. But regardless of that, you're probably going to see more selling pressure heading into the Fed meeting. If we do sell off, say down to 400, and then the Fed meeting happens and they only raise 0.25%, it might be seen as a positive. On the flip side, if the Fed only raises 0.25, the markets might freak out because they're not going to get inflation under control and they're not going to have room to cut rates when a recession ultimately does come. And from the GDP report, like I said, it looks like it's coming sooner rather than later. On top of that, if the Fed raises 0.5%, then the markets are going to freak out about you know, the Fed putting us into a recession even faster. So the way that I kind of look at that is a lose-lose, but a lot of the time when the markets are in those lose-lose scenarios, it's bullish, right? Everybody was bearish on Facebook. Facebook earnings were terrible, like absolutely just nasty. They guided down and everything, but the stock went up 18% because everybody was bearish on it. So that's what we could look forward to heading into next week. I'm not a fortune teller. I don't know, so please do not ask me. It's 50-50. Literally at this point, I would put my money on seeing a bounce after the Fed meeting, but again, I simply don't know, right? The markets are very unpredictable right now. But as far as next week, how that translates for AMC stock, well, AMC was very good today. I mean, AMC really did not do bad whatsoever. Like, it was a very strong day. We were only down 2.17%, and after hours up 0.13%. Considering the broad markets, S&P dropped 3.63%, Nasdaq down 4.17%, the Russell 2000 down about 2.81%. The fact that AMC did better than all of those indexes that are seen as a lot safer stocks, it's really, really good. Now, I will say for AMC, they do have the overall trend with them. The trend is definitely AMC's friend. The trend is for people to put money into recovery type stocks, for travel stocks, for consumer discretionary services, right? Things people want to do, they don't necessarily have to do, like go to restaurants, go see a movie. So in that regard, AMC does have a really good tailwind that is helping to push the stock higher, or at least keep it somewhat neutral. It's not cratering. It's, it's not necessarily green on bad days like today, but it's not dropping nearly as much. Now you're heading into the $15 price, and that's going to be a key level of support, and I think we likely will hold support around $15, even if on the SPY we do come down to $400 before the Fed meeting. That would be another 3.5% down on the S&P. I still think the AMC stock will hold up 15 very, very well. It could go under that slightly, like we've seen today, $14.70 per share. But I think overall, we will stay around that $15 price. If it's a buy the dip kind of moment and the Fed comes out, whatever they do, and the markets are very happy, then you're heading back to $18.29, if not $21 per share. Look at the last time the Fed reversed course. I mean, you went up 200% in the stock. So I wouldn't get too carried away one direction or the other. I will say AMC stock has sold off a lot, and it's at these attractive prices just for average investors. Like the business is getting better. It's not a meme stock, quote unquote, anymore, given its valuation and given where it currently trades at. So I think the stock is very much de-risked, and we should expect to see something like this if the markets take the Fed meeting on Wednesday bullish. If not, then I think we will hold a lot of support in between $15, possibly as low as $12 per share. I really don't see us going like sub $10. You've already seen, in my opinion, most of, if not all of the pain you are going to experience in AMC stock. Now, before we wrap up this video, we did cover a lot, and I don't want to make this video like 30 minutes long. It's already going to be a long video. We could see for Friday, the option flow activity. We had 4 orders totaling $161.96 thousand, positive order value of 49% over the past week, 15% positive order value, 110 orders totaling $30.76 million. The short interest sitting at 18.96%. Shares that are sold short of 97.73 million, cost to borrow max of 2.73%, and the utilization of 100%. The days to cover sitting at 2.49. So we are very primed to see a short squeeze, and I know there is a lot of stocks that are actually, going up right now, that are going up in a massive way. Look at Redbox. So you need a catalyst. Once that happens, there's going to be a lot of pressure on shorts to cover on their AMC short positions when AMC does have a catalyst and it does go up in a substantial way, in a day or a couple day period. I think you're really primed to see the MOAS given the liquidity situations that we are in right now. From now until the end of the year, things are going to get a little bit crazy for AMC stock. So that is going to be all for this video. Hit the like button, subscribe to the channel, do what you guys got to do. Source your comments, questions, or concerns down below in the comment section. I'd love to hear from you guys. Make sure to have a drink on me. Well, not really on me, but in memory of me and the pain my portfolio has been seeing in the markets, or your portfolio. Doesn't matter to me. Just have a drink, enjoy your weekend, and I will see you in the next one.